Have you ever thought about how people fund these large commercial projects? Whether it's an apartment complex or office building, even a warehouse. It might be like a 20 million, 30 million, 40 million, whatever size project. How are people actually buying these deals? What I can say is that it rarely is all cash. Usually there's going to be layers of different funding sources like debt, equity, even grant funding, tax credits, you name it, a whole bunch of different things. And all of these layers on top of each other is what's referred to as the capital stack. And that's going to be the subject of today's video. My name is Sita Dambuya. I'm a commercial real estate consultant. I help people acquire and fund commercial real estate deals. And today I'm going to break down what the capital stack is, or what are the different components, how it's structured, and how you, as an operator or developer, can understand it to be able to leverage it when you're acquiring deals. It's very important to be able to do this to be able to acquire commercial real estate. Let's get into it. All right, so for one, what is a capital stack? Now, why do they call it a capital stack? Now, as I mentioned before, that is layers of funding that go one on top of another to be able to fund a commercial real estate project. And it's specifically a stack because the order of the funds are very important. They're stacked in order of least amount of risk, highest amount of control, and lowest amount of upside, all the way up to the opposite, the most amount of risk, least control, and the highest upside. So it actually is a stack, and we're going to get into each of the different layers. The bottom layer is going to be conventional debt. Above that is going to be mezzanine debt. Above that is going to be preferred equity, which has some similarities to mezzanine debt. They kind of sit in that middle layer, and then top is going to be equity. So that's going to be your a very simple, typical capital stack. Not every deal is going to have all of those layers, and some deals may have even more layers. I've seen capital stacks with like 10 different funding sources. So a lot of different ways to be able to fund a deal, but this is going to be a generic uh, generic example that can give you an idea of what we're looking for. All right, so how is there less risk at the bottom? So there's less risk because at the bottom is conventional debt. That is in first position. So you'll hear that a lot of times. They look at first position, second position, etc., etc. And that means in the case of a foreclosure, say you have a property, you got all of these layers on the property, you have all these layers of financing. If you foreclose on that property, you lose that property, what they're going to do is they're going to try and sell that property to be able to recoup the money that was put in terms of debt and equity into the project. Now, say the project, you have a $10 million loan, you got $5 million in equity. But once the property forecloses and it goes to auction, it only sells for 9 million. So you have a $10 million loan, the property sold for 9 million. So that 9 million is going to go straight to the lender that provided that debt, that senior position debt, because they're in first position. Then after that, well, there is no after that because there's no more additional funds. So whoever put that 5 million in equity up, they're not getting any of that money back. That's why they have the highest amount of risk, but they also have the highest amount of upside. Say this particular property, maybe it doesn't foreclose, maybe it goes to be able to sell, 3, 4, 5 years down the line, you're able to improve the value, you're able to sell, and you get $20 million for it. So you have $10 million loan. Now there's an additional $10 million in equity, profit, whatever. The equity investor is able to share in that upside along with the general partners and the people who did the deal. So there's more risk at the top, but there's also more reward and upside if the project goes well. At the bottom is the opposite. There's less risk because you're paid first, but you also don't have any type of upside if the project does extremely well. All right, so let's go through each layer one by one. So as I already mentioned, your senior debt, which is at the bottom, is going to be the lowest risk, also no chance of upside. It's also going to be the easiest to source. Because it's less risky, it's typically easier to find lenders. Actually, they'll try and find you, if you know what you're doing. They'll find you and you'll be able to connect with lenders pretty easily to be able to source debt. It's a lot more straightforward of a process. Of course, there's a lot of different nuances being able to structure debt, so you got to understand that. But for the most part, you're not going to have trouble finding debt as opposed to the other layers, especially equity is going to be a challenge. Now, your senior debt is pretty much just a mortgage, which most people are familiar with. Like if you ever bought a house, looked at a house, is basically a mortgage on the property. And it's typically going to be between, call it 60 to 80% of the overall value, or the overall purchase price of the property. So just expect that. So 60 to 80% on that senior debt position. And, depending, there may be 40 to 20% left. And that's where the other layers can come into play. Now, the next layer is going to be mezzanine debt. So this sits above senior debt. So mezzanine debt is typically going to be in second position. So if you foreclose on the property and you can pay out the senior debt and there's more left over, the next lender to be paid out is whoever provided the mezzanine debt. So the mezzanine debt is going to be a little riskier, of course, because they're sitting behind the first position senior debt, so it's a little more risk, but you also have a higher interest rate. So mezzanine debt is still debt, so they're going to charge an interest rate. So they're going to charge you more because they're taking on more risk. The benefit of having mezzanine debt is that it reduces the amount of equity that the investor, the operator, is going to have to bring to the table. So the next layer above mezzanine debt is going to be preferred equity. So preferred equity gets paid out before common equity. So if you're familiar with stocks, you probably understand the terminology preferred stock versus common stock. So there's some similarities here. So preferred equity is kind of a mix between equity and debt. There's going to be a fixed return, but there's also limited recourse. So like in the case of a foreclosure, your lender that provided your mortgage, they can foreclose on the property. They can pretty much call the debt due, and take control of your asset. Whereas in preferred equity, even though it kind of has some similarities to debt, they don't have that same power to be able to just take control of your property the same way that debt does. But again, as we move up, there's a higher return associated with preferred equity, even though there's a little less risk than just standard common equity. All right, now common equity has the most upside, the most risk, and it's the hardest to source. So by most upside, as I mentioned before, the property just makes a killing. Like if you sell it for 3 times as much as what you bought it for, and there's a huge profit on the back end, common equity investors are going to be able to participate in that upside. So it can be very lucrative. You can get outsized returns by investing in that common area class. It's also going to be, of course, more risky. If that property forecloses, you got all these different layers, which it may be just senior debt, but it may be senior debt, then mezzanine debt, then preferred equity. All these layers that are in front of you have to get paid out in the case of a foreclosure, so there may not be anything. So common equity has the highest chance of losing your entire investment, and that's a challenge. It's also the most difficult to source. Equity investors, there's 2 different ways you can source it. You may do retail investors where you're raising maybe like friends and family or professionals that you network with in a 506B or 506C syndication, and you're raising maybe call it 50, 100,000, 200,000 at a time from individuals, and you're pulling that capital together to be able to close a deal. Or you can go through like more the institutional route where you're going through a private equity firm, family office, or any other large firm that they're going to write a check for like 90% of your equity, and then maybe like a 2 million, 5 million. More commonly, they want bigger checks, like call it 10 million, 20 million minimum. But either way, it's very difficult. It's going to be the most challenging to source equity for your project. Now, if you're getting some value out of this video, please go ahead and like and subscribe, leave comments. Let me know what you want to see or anything that needs to be covered. Now, why is it so difficult to structure a capital stack, and how can you do it? For one, there's a lot of different funding sources out there. Like there's just almost infinite. There's so many different funding sources that they're always coming up with new ones. So it's very difficult to know all the different sources that you can take advantage of. But the more that you know is like having another tool in your tool belt, so you can solve more problems, come up with better ways to structure a deal or finance a deal. What we went through is, a very simplified version. It's kind of generic in terms of the categories, but you can have so many different layers of funding. You can do, standard senior debt, which that has its own several different options. You go through standard agency. You can go get a bridge loan. You can go through Lifeco. Like there's so many different funding sources at each level. Then you can do mezzanine debt, different sources for mezzanine debt. Then different sources for equity. You can have like tax credit equity. You can have grant funding. You can do like new markets tax credit, historic tax credits, LIHTC and low-income housing tax credits, solar. There's so many different funding sources, and the thing is, each layer affects the other layers. Equity might not work with certain types of debt, and vice versa. So you got to find different ways to make these funding sources work well together, and that's why it's such a difficult task being able to structure deals. And a lot of times each funding source has its own stipulation, especially if you're doing something that's like impact investing or community development based, where you may get grant funding or a particular loan for a particular type of project, but they want to see a particular type of impact, and then each layer of that is going to see a different type of impact. You got to find different ways to make them all work together, and some may contradict, so it can be very complicated. But don't get overwhelmed. The more that you know, and the more you follow this channel and see me talk through all these things, the more you'll have an understanding of how to make these different structures work together. So what you'll commonly see in any commercial real estate deals is sources and uses table. So when you're buying an asset, you're going to have to fund the purchase price, closing costs, renovation costs, working capital, reserves, etc. There's so many different things that need to be purchased. So in the sources table and the uses table, your uses are going to show all of the different uses of the funds. So everything I just mentioned, your purchase price, rehab, etc., is going to have it all listed out, and it's going to all be totaled. Then you're going to have a sources tab or sources table, which is going to show all of your funding sources. So your senior debt, your equity, if you have a GP co-invest, tax credit equity, etc., etc. All your different funding sources, and the total needs to be able to line up with your uses. So that way you have all of the funding you need, and it's very important that you know where every single dollar is going and where that's being spent. All right, now here's a real world example. This is our 100 unit we acquired in Metro Atlanta a few years ago. It was about $6.5 million on the purchase price, and it'll be about $7.6 million total project cost. And here's the actual capital stack visualized. So we had a senior loan on the project, and we ended up getting bridge debt on it because it's tax credit property. So we have planned to do tax credit takeout. So that's why we got short-term financing. Then we assumed a loan. So assumed a loan means there's a loan that's already on the property. When you acquire it, you just take over that loan instead of paying off that loan with the new loan. So we assumed a supplemental loan that sits in second position behind the senior debt that we got to acquire the property. So first layer is going to be the 4.18 million senior debt. Second layer is going to be supplemental loan, and then the third layer is equity. So we didn't have like a preferred equity in this project, just standard equity, which we syndicated. So we raised a little over $2 million from 43 different investors to be able to fill that gap. So now senior loan, supplemental loan, equity, and that's our capital stack that allows us to close this project. Now to wrap things up, there's a lot of different funding sources that you can use to be able to acquire or develop a project, and it can be overwhelming, but the more that you know and the more tools you have in your tool belt, the more creative you can be. So understanding how to structure deals, understanding all the different funding sources and how they can work together, and knowing the ins and outs gives you a competitive advantage because you're going to come up with more solutions to be able to close deals. I can tell you from experience, like pretty much half, if not more than half of your time in commercial real estate is going to be spent on financing, figure out how to finance deals. Commercial real estate, more than residential, is about finance and capital just as much as it's about actually doing and operating and acquiring real estate. All right, till next time, please go ahead, tune in, leave comments, likes, check out the next video. I'm going to be talking a lot more about capital and lending, etc., etc.